As of this weekend analysis on Saturday, July 11th, 2026, the traditional equity markets are closed, meaning we are looking at the final recorded metrics from the last active live session on Friday, July 10th, 2026. During that final session, Nokia stock concluded its normal hours of trading at an official price of $12.44 per share. This closing figure represents a sharp intraday downward movement of 3.57%, with the stock experiencing noticeable selling pressure after opening the day at $12.48, hitting an intraday peak of $12.62 and dipping to a low point of $12.26. Now, the natural expectation for an asset moving like this is that it is simply tracking the broader cooling off of defensive technology positions, but the reality underneath this price action is far more compelling. While the retail crowd assumes this downward slip is just another boring drop for a legacy telecom hardware maker, institutional order flow tells a completely different story. Major market participants are actively resetting their exposure because Nokia has quietly emerged as an essential physical infrastructure provider for massive data complexes, even as legacy mobile network operator spending remains stuck in a cyclical rut. This creates a fascinating divergence where the headline numbers look weak, but the underlying core asset is building a structural foundation that most retail participants are completely missing as they browse standard investing sites looking for quick gains. To understand why this gap between expectation and reality matters so much, we have to look at how the average person views this asset. For the typical retail participant using a standard individual brokerage or checking regular stock updates on their phone, Nokia is often dismissed as a relic of the late 90s mobile phone boom that somehow survived but never managed to recapture its former glory. The general consensus is that it is a slow, bureaucratic, utility-like business tethered entirely to the slow capital expenditure cycles of global telecom companies. But when you challenge that assumption with hard structural data, you realize the contrarian take is much more powerful. Nokia is currently experiencing significant daily trading swings and experiencing trading volumes that exceeded 50 million shares in the last session alone, a level of liquidity that usually signals intense institutional repositioning rather than retail indifference. When people think about putting capital into an online investment option today, they usually lean toward high-flying names, yet sophisticated allocators are utilizing interactive brokers' stock trading platforms to build sizable positions here. They see that the firm is no longer just waiting around for telecom providers to upgrade their cellular towers. Instead, it is capturing a significant share of the optical network market, which is growing rapidly due to the dense fiber connections required by modern high-performance server clusters. Let's break down the recent market movements and trading technicals to see exactly what the institutional desks are doing. The stock has been trading within a 52-week range of $4 on the low end to $17.45 on the high end. This massive spread demonstrates that the stock is anything but stable or boring. The recent drop to $12.44 has pushed the trailing price-to-earnings ratio up to an elevated level near 76, a number that sounds shocking for a legacy telecom firm until you realize that temporary earnings contractions combined with long-term infrastructure revaluation are skewing the traditional metrics. Institutional filers, including heavyweights that control major allocations in Fidelity Investments and large-scale pension managers, have been adjusting their books ahead of the upcoming fiscal second quarter earnings report scheduled for July 23rd. Interestingly, institutional documents show that even major technology players hold notable stakes or partnerships, creating a buffer of long-term stability. This is why when people look at their Fidelity mobile app or manage their self-investing accounts, they need to look beyond the surface-level tickers. While individuals are busy chasing volatile price spikes on a basic Robinhood app, the structural volume trends indicate that larger entities are using the current downward daily swing to accumulate blocks of shares without driving the market price up prematurely. This constant tension between public perception and actual institutional activity is heavily influenced by the wider macroeconomic environment. High interest rates over the past few seasons have put a strain on regional telecommunication operators, forcing them to delay their next-generation network expansions. This delay is precisely why the mobile network division has shown soft top-line numbers, creating the expectation of a stagnant corporate outlook. However, the reality is that the optical networks business grew significantly year over year, driven almost entirely by automated data center build-outs. When an investor opens their SoFi trading platform or sets up an individual portfolio through an online investing service, they are usually confronted with a barrage of news focusing solely on cellular contracts. They miss the fact that major entities are modernizing their transport infrastructure to handle massive data transfer loads. For anyone seeking investment help or attempting to construct a balanced portfolio using Schwab Intelligent Portfolios, understanding these deeper sector dynamics is crucial. The macroeconomic pressures are real, but they are acting as a temporary dampener on a business that is fundamentally changing its revenue mix toward higher-margin corporate contracts rather than low-margin carrier equipment supply chains. Now is the perfect moment to consider how this fits into your own broader personal portfolio strategy. Comment below how many shares of Nokia you currently hold in your account, or share your thoughts on whether you think legacy tech companies can successfully capture the modern infrastructure market over the next 12 months. Tracking these shifts requires looking closely at how the entire digital communication landscape is organized. When you look at the popular tools on a SoFi Invest portal or trade through a Fidelity brokerage account, you see a clear dividing line between companies that build software and companies that build the physical machinery that allows that software to exist. Nokia belongs firmly to the latter group. Its business model is built around high barrier-to-entry manufacturing and intellectual property. The company operates through distinct segments, including mobile networks, cloud and network services, and network infrastructure. This infrastructure piece is where the real variance from expectation lies. It includes subsea cables, routing systems, and optical transceivers that connect different server buildings across continents. The past performance metrics, like the annual revenue figures from previous years, showed a business trying to trim fat and cut operational costs. Those cost-cutting measures are now paying off, allowing the firm to maintain positive net income margins even when global equipment demand hits a cyclical low point. To fully grasp the structural setup here, it is helpful to compare this asset's behavior with the wider market. When retail traders log into their Robinhood stock trading dashboard, their attention is inevitably drawn to the explosive moves of mega-cap choices like Tesla stock, Apple stock, or Nvidia stock. Those businesses command massive premium valuations because their growth stories are obvious and loud. In contrast, an asset like Nokia requires an investor to look through a different analytical lens. If you are using a SoFi robo-advisor or allocating capital via Fidelity mutual funds, you are looking for structural stability coupled with mispriced upside. The current reality of the telecommunications equipment sector is that it is highly consolidated. There are only a handful of global firms capable of building secure, reliable, large-scale networks. With geopolitical shifts restricting certain international competitors from operating in Western markets, Nokia enjoys a protected market share position that ensures it remains a primary vendor for national infrastructure projects. This long-term defensive moat is something that simple automated algorithmic trading programs, like those driving a basic intelligent portfolio, sometimes undervalue because they focus entirely on short-term price momentum rather than structural asset value. Looking closely at the underlying technical data available on advanced platforms like Interactive Brokers platform, we can see that the short-term trading patterns are heavily influenced by short-term options hedging and open interest positioning. The recent drop of 3.57% on heavy volume indicates that short-term momentum traders are exiting their positions as the price broke below key moving averages. This creates an excellent entry point for long-term self-investing accounts that focus on fundamental value rather than daily noise. When managing an individual brokerage account, it is vital to separate the noise of a single day's trading from the multi-year capital expenditure trends of the industry. The upcoming earnings report will likely show clear challenges in the European carrier sector, but if the optical network segment continues its double-digit growth, the market will be forced to adjust its expectations. Many individual investors who use basic investing sites often make the mistake of panic selling during these minor cycles, forgetting that institutional allocators look at these events as liquidation opportunities to buy assets at a discount. As we look toward the future outlook and map out the potential long-term scenarios, the contrast between expectation and reality becomes even sharper. The bearish scenario, which many retail observers are currently pricing in on their Robinhood investment screens, assumes a high corporate debt levels globally will permanently cripple the expansion plans of telecom providers, leading to prolonged revenue stagnation for hardware suppliers. In this view, the stock remains trapped in a low